Good afternoon. Welcome to another episode of FinTech and Web3 Founders. My name is Gaurav Dhar, and unfortunately, today my co host Ronit Ghosh can't be with us due to technical difficulties, but he's here with us in spirit and has left some questions for us to ask our esteemed guest today, Gary Sheynkman. Gary, welcome. It's a pleasure to have you here with us today.
Thank you. I too would like to be able to not participate in all sorts of calls because I am taking fabulous vacations in remote places that don't have fantastic connectivity. But we'll enjoy answering the questions and hopefully he'll get a chance to not only review my answers but also not have an opportunity for any rebuttals.
I think there are privileges and disadvantages to not being a participant on this podcast when we're talking about about the person in question. So, Gary, thanks so much for joining me and us, my partners CFTE here today. I think you're not an unknown entity, so I think there's a degree of comfort which I'm going to take advantage of and hold a bias in trying to really give our listeners and people who might look back on this podcast, specifically with the topic that we want to touch on, which is venture studios and venture building. But before we get into that specific subject matter, tell us about you. Who is Gary Sheynkman? Can you tell us a bit about yourself and your background?
Sure. Appreciate the opportunity. Knowing that I probably know some of your listeners, I probably can't embellish too much, unfortunately. Hi, dear listeners. My name is Gary Sheynkman. Spent a good chunk of my career at kind of bouncing between being at companies that create software, being at companies that consume software, and then for the past decade or so, focused on early stage venture capital. And that has taken shapes in bringing tech stars to the Middle East, working very closely with 500 startups across their programs in emerging markets, running a fund that focuses on early stage investments. And now I am a venture partner at a studio or a venture builder. There's many names for these things these days, called Further. We're based in Abu Dhabi, and we are focused on building infrastructure for financial and digital assets, quote unquote, which I will now refer to as crypto for the rest of this, startup, for the rest of this podcast. I've been very fortunate to work with a lot of founders, and over the years, in kind of all the different configurations that you can imagine. I've also been a failed founder, having raised and ran companies into the ground. So I have a little bit of experience doing that. And then, I think I have to mention that I run a infamous happy hour for founders in Dubai, where we all merrily drink margaritas and wear sombreros, once a month, and hopefully provide a forum for people to meet more casually outside of podcasts and panels, and hopefully, make some friends and find co-founders and sometimes investors.
That's a lot to unpack, Gary, and I think for people who know you,
I'm just old.
it seems very normal to have that introduction from you, but I think uh, justice needs to be done to your profile a little bit more in breaking down those components before we can talk about you and what you actually do at Further, right, in Abu Dhabi with venture building and venture studios. So I'd like to focus a little bit on some of the things that you also didn't talk about. But the first things, you know, I believe you started in software companies. I believe you've had a journalism software background as well in the United States, and then you've had a stint at Dubai Futures Foundation as well, right? When the scenario here for venture building had just started, correct, in the venture capital space rather than the studio space.
Correct. So I think I'm relatively new to studio world, just in terms of operating within it. I've been exposed to it through some investments that we've done previously in some studios in the U.S. Not through Further, that we do that as well as part of our mandate. In terms of personal background, I started my career in video infrastructure. And so that's everything from content management to streaming, ad insertion. So really everything that happens kind of between the camera lens and your eyeball. And that includes everything from how files and metadata is handled, all the way through to how it's played back on the actual client side software to make it work. And so I spent a good half decade, post college, in that world on the infrastructure side, and then was leading some products within Vice Media. Um, and that was a whole lot of fun. A very interesting organization, especially as it was in its early stages. And then moved out here to do some consulting work, also in kind of the infrastructure and media space. Got to ship some really cool products with Abu Dhabi Media back in the day. And yeah, kind of fell into through some mutual friends of ours into the Future Foundation as it was creating its accelerators program and trying to figure out how can government more effectively conduct outreach to members of the technology community. Had a stint there and then very quickly realized that kind of the way to affect change is probably to do it more manually. And so I was very fortunate enough to partner with a family office out here in Dubai to bring Techstars to the Middle East. And that program was hosted within Emirates Towers, at the Future Foundation or Area 2071 facilities, and that was a lot of fun. I got an opportunity to meet a ton of folks kind of in the UAE. It's when we really started spending time together, right? As well as work with a ton of just fantastic entrepreneurs.
I think something to put into context is the timeline when these things occurred from this region, especially the Middle East. I'm not touching on the continent of Africa. I'm just talking about the Middle East. The time when you came in to start your stint, which you said at the Dubai Futures Foundation, and then move into Techstars, the venture capital landscape was in its absolute infancy. How long ago was that now? How many years has it been? 5 years, 6 years, 7 years?
Yeah, so our first cohort was 2018. So that means that we signed the program and started to develop it in 2017. And so my stint in the Future Foundation was 2016 and part of 2017. Um, yeah, I mean, look, I think you can look at the maturity of venture capital kind of industries in terms of just how many vintages have been around between funds. And we have fund managers in the UAE, that have their third and fourth vintages now. And so we're in a dramatically different place today than we were back then. And look, I started coming out to the region in 2008. I spent about a year in Dubai back then. And man, I remember doing a tweet up at Barasti, which was relatively new back then. And you can fit all the users of Twitter at a bar because there was like 25 of us, in the country. And guys, you have to remember that in 2008 there was no Twitter app for the iPhone, and no people weren't really using iPhones for anything but playing music. All of us had Blackberries, or if you were really balling out of control, the E90 communicator, which was this laptop that you put into your pocket from Nokia, that could theoretically load up a web page, if you had about 20, 30 minutes to spare, to load it up, right? And so it's just the rate of change over the past decade and a half has been quite tremendous. And so I think we often talk about in kind of the ecosystem, we try to compare ourselves to more mature markets, but I don't know if it's necessarily a fair comparison because those markets might be 30, 40, 50 years old, and they're still growing and they're compounding, right? This stuff, talent pools and capital, has to work on compounding principles. And so the rate of that has been really fascinating to watch, and also because it's easier to double from a small base, and we can talk about like fund sizing and whatnot at some point in time, but it's a lot more difficult to double $1 billion than it is $1 million, right?
You're, you're,
From an
you're
investor
preaching.
perspective.
Yeah, you're preaching to the choir here, brother. I think I think everything you say is a definite nod to people who have been in the ecosystem since it started. And again, like you said, infancy, 6 7 years is really the earliest stage, and we really haven't given this ecosystem the breathing space it needs to mature before we can do anything else. I mean, stats can be manipulated however you like, and that's a separate podcast on its own. We won't get into that, but the important thing is that there was no venture capital, and being a tech entrepreneur myself, I wish, 10 years ago, there was more of what we're seeing today when I was perhaps in the infancy of my technology journey as an entrepreneur rather than now. Now I'm more active as an investor than I am a participant outside my CEO role. So I'm 100% with you that we have to give this ecosystem a little bit more time to get into some vintages and talent pool to develop specifically related to how you build businesses in the venture space. But looking at your own experience here, you've come from abroad, you've come here, you've worked with government programs, you've worked with family offices, you brought tech stars to the region, you've seen it evolve into where it is today because you've participated in the ecosystem, you've contributed to the ecosystem in many ways. But now you're part of something that's new again, right? To this region specifically. We've had incubators, we've had accelerators, we've had venture funds, we now have venture debt, we have, all sorts of programs. We have venture capital generally, we have angel investors, angel syndicates, angel groups, super angels, and now, drum roll, we have venture studios and studio builders, right? Tell me about that a little bit more. Can you explain to everybody else what is venture building in the studios concept space? We've had people from other venture studios in the region participate. We have somebody else coming on soon, and I imagine your take is similar but yet unique. So I'd love to hear your perspective from further of what that looks like.
I don't know if I can, vouch for uniqueness here, but um, what I think is most fascinating about this venture builder studio space trend, kind of the Cambrian explosion of these types of organizations over the past couple of years, is that unlike a venture capital fund in its traditional sense, LBGP to 20, deploys capital over 3 4 years, whatever that might be, and unlike accelerators, which have been pretty settled in their models, where say the YCs, CCAM, Techstars, et cetera of the world, they take a certain percentage amount. That's really kind of figured itself out. Most of them run about 3 month programs. They have specific content that is delivered to the companies at that time. The companies all kind of look and feel pretty similar in terms of their sizing, and in terms of the kind of working capital that they need to consume in order to like make the program successful, right? And so the top tier programs are kind of in the hundreds to $150,000 range, and in terms of the funding that they provide, they all end in a demo day. There's investor databases, right? Like this stuff is pretty on rails. It's non-trivial to put on a very good program, and so I applaud these organizations for kind of fighting the good fight, because it helps I think us investors get higher quality assets that are available to us to invest, right? But in the studio builder space, man, it's the Wild West. And it's largely because there isn't really a model that's been settled on as the best operating model for these studios. And look, venture building isn't new conceptually, right? Idea Lab has been around forever. Large organizations have sponsored employees leaving and then acquiring those companies, right? Like Oracle in the '90s and whatnot. There's been departments that kind of create entire lines of business within organizations, and that's venture building as well, right? It's venture building is creating companies in a systematic fashion, right, under some sort of a corporate umbrella. What I think is relatively new is you know venture building as a venture capital kind of asset class,
Right, the
right?
venture
And so
studio, as it were.
Right. Right. And so we now have this kind of concept of, all right, we have a fund that, has its typical fund life. And then it needs to deploy its resources to venture build as opposed to deploy its capital to companies. And so we have this kind of bizarre math that goes on where in a traditional fund, you might have over life of fund maybe 20% of the aggregate capital that's been raised that goes to fees. 2%, 10-year fund, kind of do the math. In a studio model, the implied fee structure is significantly higher. You're looking at 30, 40 plus percent of the capital that investors are putting into this organization. Whether it ends up being structured as a fund or a holding company, whatever it is, the math kind of checks out the same. The fee structure now is, let's say, massaged in such a way to allow the fund to not just have investment activity, but also services activity. And that services activity really varies quite actively between the different studios, right? And so you can be very lightweight, similar to a VC fund where you're just providing very point services. And those could be recruitment, those could be legal, those can be kind of other components. Or you can go all the way kind of down the track of your staffing engineers. You have a bench of designers, you have a bench of product managers, and basically you are the org chart of the company up until it's ready to graduate or spin out of the studio. And so unlike a consulting company whose role is to forever entangle the client and never leave, the job of the studio team is to very quickly work themselves out of a job by finding replacements for themselves that become founders in the company. They jump on the ESOP, and as soon as that company is independent and can stand without material resource consumption from the studio, that same core team can then focus on the next build. And so as a result, there's a million ways to slice this, right? You can have a fund that invests in the builder. You can have a holding company with a sidecar vehicle. There's just all of these ways to do this. And honestly, we've now, either communicated with, invested to, or, had some summits with, I don't know, dozens of studios at this time. And we are yet to see a common thread outside of the work itself. So, you'll see similarities in how, the best performance studios, hustle. And you have a lot of shared opinions on ownership and incentives and the way that you get companies to market. So there's a lot of consensus there. But there is definitely no consensus on the model legal structure. And, if you're like a fund or a corporate structuring or a finance nerd, there's just a lot to learn there because it's a very new asset class. And so there's just no standards to it yet.
I think, what I'm hearing is even in the incubator accelerator model, there's a very widely accepted commonality in the structure of how they're sort of presented, built, and people can consume them or participate in them. But what's really different in the venture studio model is the amount of operational involvement that actually goes into it. The perhaps money in, money out of how that structure has been set, whether it's a holding company or fund with an operator or an operator with a company in that structure, may vary. But essentially, the huge differentiator between the value creation involvement from the parent, if I can put it that way, is time and operational expertise. And that's something that actually segues really nicely. And what I want to dive into for all our listeners is tell us more about further. What can you tell us about how you approach the market as further? Also, what information people who want to contact you or perhaps should contact you would fit your thesis of what you're looking for so that they can get in touch quicker or perhaps uh, also have value for you or you have value for them. So take us through that journey of what do you do at Further today as a process and how you approach the market in terms of companies, ideas, build, and what you offer, and who should reach out to you.
Sure. So, anyone that enjoys this video is more than welcome to reach out, either just to chat or, if you're interested in pitching. Easiest way to find us is, contact form or just ping me on Twitter. Email tends to be the slowest way, unfortunately, these days. So that's always a fun way of doing it. So in terms of my role at Further, the partners at the firm are all cross-functional, meaning that we typically will take responsibility or partial responsibility for one or two builds that will be in different stages, and then we report our progress to each other as kind of during our portfolio meetings. So, for example, one of our partners who you know very well, Denise, he might be focused on, the SME lending space, and I might be focused on, uh, let's say crypto custody. He might not know what's going on day to day, at my team level or at like the internal company level, but we take the opportunity to update each other. With that said, we all have cross kind of matrix roles within the org, right? And so, if someone in, one of Denise's kind of, let's say, his portfolio startups, needs a service that, I'm more equipped to provide, then I go and do that, right? And so, some of us are, better at legal, some of us are better at software, some of us are better at products, some of us are better at, a whole bunch of things required to actually get a company off the ground. And so we are all resources, we're all just a resource pool, right? For the companies at the firm. And so there's no kind of, you know, everyone can kind of grab everyone and there's like traffic managers, to make sure that people aren't overloaded. But then, each partner will oversee and kind of really be day to day deep with the team, actually getting a product out. And so that means that up until there's a CEO and a COO and a CPO, the partner is those roles. And so you're very much incentivized to focus on hiring. A huge part of my time is reviewing resumes, getting it down to these are the people that I want to speak with, briefing our people team, and so we have a full-time, HR people and recruitment team at Further, and then telling them, great, I want to speak with these people. Let's schedule in, and then we kind of continuously go through that process. Hiring is something that a studio it, hiring is difficult, I think, for any company in the world. And a studio has to learn how to do hiring exceptionally well because by design, you are constantly bringing on new people. You constantly have people from your own internal organizations migrating to the builds because they get excited about those companies, and it's a very kind of healthy and fun experience. And so we constantly need to replenish our own staff as well as help our companies recruit. So that's a huge component of kind of the day to day. What's another kind of thing that makes us different? I don't know, man. I think a lot of studios will take a different approach in terms of how much equity and services and components you provide. I think what
Really,
makes
that's really important. Yeah, I'd love to understand how you approach your venture studio projects or companies. How much do you have a set thesis on how much you invest, for how much equity you take in a specific field or sector, or is it completely fluid? Is there a template, or is there something that's just
so
in every company?
I think finance is like fashion, man. Once you know the rules, you can break all of them. And so I think you always start with a model and an approach that on a spreadsheet, gets you to the ownership post solution that you require. But different companies will need to have a different amount of involvement for a different amount of time, and will have different capital requirements. So rewinding a little bit, I think that the best studios in the world do things that startups with venture backing would struggle to execute on, largely because either you have material capital requirements or you have very complex research requirements that make it difficult to do a traditional, hey, I did a small friends and family round, I'm proving something out, I'm talking to customers, I've gotten to a certain stage where I need to get a little bit more capital in. I think that again, the best studios out there, they really understand, what they're better at, and they know how to make their companies perform. So for us at Further, we were fortunate enough to have a good capital base to go after regulated spaces. So we create companies in financial and crypto infrastructure, and those kind of bridge the Web 2, Web 3 divide in many ways. And that means that we spend a lot of time talking to our regulators, and getting our companies from, all right, we have a product, it's super cool. Now the powers that be need to let us, actually market and service those companies. And excuse me, not not only like this is not something that's unique to our market. Regulatory journeys are long and tough if you're offering complex financial products to the market. And so I think if you've spoken to many fintech founders here, and they will all tell you that, man, it's rough to survive that time between when I've submitted my packets to when I'm given the conditions to actually incorporate and what that entails. And as part of that, there's always that very scary bill because you don't quite know what are going to be the regulatory capital requirements that the regulator mandates that you have on the balance sheet in order to launch your business. And that could be, the kiss of death for a startup, right? Because as a VC fund, especially if you're a little bit smaller, you really don't want to see your capital locked up in reg cap on the balance sheet. Um, right? You want to put that towards hires. You want to put that towards growth. And so it's quite dilutive for early stage founders to raise off of their equity for capital that they don't actually get to use to grow and develop their business. So we typically will look at doing $5 to $10 million pre-seed checks into the companies that we ourselves have, knowing full well that a third of that, if not more, will be locked up, knowing full well that the company might need to run for a year, building its technology and talking to the market before it's actually allowed to generate any revenue by its regulator. And so, the mode for us at Further is we go after exceptionally difficult regulated spaces in the infrastructure world. And we feel that there is a space there because it's difficult to find capital, and it's difficult to build a team with enough depth of regulator experience in order to operate effectively if you're just one startup starting out. We have a full-time regulatory attorney, consultants, all this kind of stuff that support us when we try to guide our companies, right? We're the ones that are, filling out the JIRAs for the FSRA, right? We're the ones that are in there and actually making sure that we kind of craft our applications in a way that's palatable to the regulator, and also guide our founders in how they think about their product, so that they're actually creating uh, enterprises that would be palatable and exciting for the regulator to showcase, right, as good examples of companies that should be coming to market.
It's super interesting. It's very clear now the direction which you're heading and how you're approaching it. But I just have to highlight. I mean, I'm sure anyone who's listening to this right now, when you said $5 to $10 million pre-seed, everyone's eyebrows went up universally. That's a huge chunk of money. It's something that's not common for this region at all at pre-seed. In fact, actually, with my limited experience, and I think I have experience than a lot more people, generally speaking, who are just under being full-time professionals in this space, that's pretty much unheard of as a common standard. I haven't heard across this entire region, even funds of a sizable nature, that
Yeah.
five to
So
ten million pre-seed. Wow.
so I want to be clear here. It's not like I wire the money. We milestone this stuff out, and so the teams have to actually complete the work. But it would be very silly of us. We're very excited to be launching a custodian business, but it would be very silly of me not to allocate enough capital that wouldn't cover a team and its regulatory requirements, and enough runway to convince other people in the market to actually use this service to keep their keys.
I'm with you. I'm with you. But but you're sort of setting a new precedent here. First of all, 5 to 10 million tickets pre-seed. Second of all, by the sounds of it, entering with the thesis which you're going in, which is a highly regulated space, surely your term for realizing an exit must be longer. Typical space is 5 years plus to 7 years or plus 1 or 2 years. Are you looking at a longer space for return on your investment from this capital than traditionally people would look at?
I don't think so. I I think us, the VC fund management community, has been telling people a lie for the past half decade or so, that liquidity comes in that 7-8 year mark in out of funds.
It
you know
does.
the reality is that the reality is that most funds use up their extension periods that is available to them in their terms, and that companies are staying private for significantly longer. And right now, there's really no IPO windows. So whatever plans people might have had 2 years ago, that's out of the window. We're looking at probably another, I don't know, 12, 18 months, 24 months. Who
Yeah.
who knows? In terms of not having kind of a very hot market in venture, and so I don't think our expectations are any different. It's just that we choose to launch firms with uh, business models and regulatory postures that we think would be difficult to execute without our model. And look, if I can launch a company for dramatically less than that, amazing. But the reality is that um, we don't want to be in a situation where we didn't allocate enough capital as a fund to get the company to Series A without having to go and ask for small checks. It's just a distraction. And so we're building incredibly complicated infrastructure in a relatively new field, in an environment where the regulator is receptive but new. The actual data center infrastructure, isn't as developed, as it is in some other jurisdictions, and we have to think about data residency and all of these kinds of questions. And so the last thing that you want to think about is, oh, we've provisioned for a year or 18 months only for this company to kind of shoestring budget this stuff, and then we have to think, oh, you know, it got revenue, it now needs to increase its regulatory capital, or it's the other thing that I think is not smart is trying to time the market, right? You could be, right now we're very fortunate. We think we're in a good vintage. We launched, just this past September. But, you know, man, tomorrow the Fed can go to zero, and right, like we just don't know.
Let's not
And
even get
so we,
into that. Let's not even get into that
right,
conversation.
yeah,
But I'm with
yeah,
you. But I think what's interesting moving on from this point is right is time is the finite capacity for you, and so is the funds that you've allocated before you take the companies to Series A or Series B, with how you're funding them to start with. So my next question for you, and my listeners will want to know, or our listeners will want to know, is how many companies are you looking to support over your lifetime with the fund? And can you tell us how big the fund is? What is publicly disclosable? I mean, can you tell us more? Do you take 3 companies a year? Do you take 2 companies a year? Can you take 25 in total? If you can tell us a little bit more about that, it'd be good to understand if you can.
So sure. So what's public is that we're about a $200 million fund. Um,
Oh wow!
and so that's the size. We're primarily backed by ADQ, which is one of the sovereign wealth funds in Abu Dhabi. The fund is still open for those that are interested, but we don't really see ourselves actively trying to close additional capital. We think that it's tough to put the money to work and learn how to build an organization from scratch. And so, we're on this really interesting journey, and we're really focused on building at the moment. Look, I don't think that all of our companies will require just deep material capital to launch. But a lot of our, I would say, bedrock companies that will create kind of the core foundation of the ecosystem that we want to create are going to be, by their nature, more expensive to launch, right? And so on the fintech side, we want to solve no personal guarantee SME debt. And that is really complicated to solve. It's capital licensing, it's fund management, it's all this kind of stuff. We want to solve savings and retirement. And that's not just building, the client side application and building a really cool experience. It's really working deeply to think about how trusts are structured, in this part of the world, how retirement benefits work, how end of service benefits can be converted to retirement benefits. What does regulation look like in 2, 3, 4, 5, 10 years as more people are going that are expatriates are becoming of retirement age in the region, and the region seeks to attract those people for the long term. And so like those things are really, really important. But if we nail that, and on the crypto side, it's on-off ramping and banking and custody and swaps and embedded finance. If we get that stuff right, building companies that take advantage of that infrastructure to provide really cool consumer and retail experiences to do other financial products, those get lighter. Those get easier. We don't have a partner bank as a service stuff where you can just jump in, like call them with an API and build a neobank, right? We don't have, a lot of this core infrastructure that, when you point to cool financial products in the US or the UK is fantastic at this, or kind of parts of Europe, you're like, oh my God, you can do all this stuff. And then, yeah, it's because there is 2 or 3 layers of fairly significant foundational companies that are servicing those startups. And so for fintech and crypto, we're choosing to go kind of bottoms up and build those foundations first, and then hopefully like our per build price goes down a little bit.
So you've got how many companies? I mean, you only started 1 year ago, huh? And I guess it'll ramp up to some point and then slow down at some point of your cycle of, let's say, 5 to 7 years. But with $200 million, 5 to 10 million, you do a bit of rough math. It's anywhere between 20 and 40 companies over that lifetime. Does that sound right? As to doing some sort of an average, you'll say you do maybe 20 to 30 companies over the lifetime of the fund.
It's probably going to be less than that. And
Nice.
so we want to, I think bigger infrastructure companies, when they go out and raise their Series B, they need to be like really materially capitalized, and so we want to maintain ownership. And so we maintain quite a bit of our fund for reserve capital.
Oh wow.
Um, a part of our fund is allocated to investing into other funds that we view for partnership opportunities. And so you can go to further.ae/network, and you can see some of the other venture builders, primarily in the US, but some in other areas of the world that we've deployed to, and those kind of become public as we're allowed to speak about them. Um, I think building 20 companies over the course of, let's say, an investment period, 3, 4, 5 years, is exceptionally difficult.
We appreciate the
We
require on that one.
Yeah, I mean, we're running with 4 right now, and it's hard. I think that we had a very robust start, and we're very eager. And when you are in that kind of, I think, what did Musk say about like the Model 3? It's like manufacturing hell. And so when you're actually trying to create all of these organizations all at the same time, that puts stress on us. And so I don't think that it's possible for kind of our model and our team size and the amount of attention we want to give each company to do more than, you know, 2, 3 builds a year. I think originally we wanted to do, can we get 5 done? Can we launch 5 in a year? But we are extremely concentrated in each build as part of our model. Now, there are other venture builders that have the complete opposite approach. We know the guys at Fractal in New York, for example, and they launch dozens. And they're highly focused on creating an engine that allows them to do these experiments and launch these companies. The guys at Redesign Health, in New York, they're healthcare focused, and they have a massive research team that's constantly running experiments. Excuse me, and they're focused on that. And so, this is what I was talking about a little bit earlier on in our conversation, is that there's really no prescribed way to run one of these organizations. You kind of have to have conviction in your own model, and then you have to go for it.
And just looking at what you guys are up to and where you're going right now, you had mentioned that the fund is still open for investment. So that must be, I mean, significant capital. It must be a very significant minimum tickets, and must be very selected people you would allow to be investors in a fund like this. I mean, is there any guidance you can give to people? Because I know there are a lot of significant family offices in the region that potentially have capacity to do this. I don't know about individuals that would do that at such a large extent. Is there any insight you can give us on that piece?
So we're institutional focused. I think we'd like to keep that for the first fund, and to prove out that we know what we're doing, and to kind of see where it goes over the next few years. I think if large corporates that have distribution, that want to partner with us, want to have a conversation, we would very much welcome that. I think for you know all venture studios, um, the dream investor is an organization that has distribution, but doesn't necessarily have a built-in capacity to do their own venture building. And this is why you see a lot of venture builders as a service that offer this to corporates. And some corporates go the complete other directions where they just become an LP in a venture builder, and have a kind of a different approach to doing that. I don't think one is more right than the other. I think it really depends on what the corporate is seeking to achieve. Um, but we, especially in the cybersecurity and the healthcare space, we see a lot of LPs that are strategic and independent studios, because they can run quick enough and attract the right kind of folks, and that works quite well for them. And so I think for large companies in the kind of financial technology space, then I think that would be super cool for them to reach out and hopefully talk to us about an investment. If someone is listening, you're more than welcome to reach out.
And also, just touching base that the fund actually does investments into other vehicles as well. There might be some people out there that have smaller vehicles that are looking to get funding or work with you in some capacity at further. What kind of people, you said you mentioned you've invested in some other venture builders and studios globally. So it sounds like a global but very finite investment mandate. Are you investing in funds in this region as well, or you're investing
um,
globally with a mandate to build yourself regionally?
so I would say that our priority is to learn, and so our average ticket size for funds is materially smaller than our average ticket size for a build. And we want to take the opportunity as a relatively new firm to learn from venture builders that have multiple vintages. That where we can say, great. How did you go about structuring your second fund? How did you deal with when your company got to a certain size and you needed to support them? And so network building there is very important for us as managers. What's also very important for us is having some sort of symbiosis with our own thesis. And it doesn't have to be kind of super obvious. But for us, it's how can I put a head of technology, a head of product, a CEO, another leader in the company with a peer in a different market that is solving for a similar finance, distribution, technology, or other problem. And so, we in many ways, companies that work on similar problems, and again, it doesn't necessarily have to be obvious, right? It could be similar ticket sizes or similar distribution or kind of, other factors that go into company building. That tends to be the priority. We'll also look at kind of brand new managers that are doing something drastically different. But, they have to be innovating on either the model or do something where we're saying, hey, this is way outside of the envelope, but it's fascinating. uh, you know, we haven't really seen a lot of folks doing the studio model in material science. We haven't really seen a lot of like kind of hardcore science work being done. I think it's typically the land of like really experienced, venture capital firms to be able to do this. Um, it's something that fascinates us, and we think that there's potential for really good financial outcomes for the firms that crack this stuff.
I think it's super interesting. The only thing that I'd love to ask you as a preliminary question to my last question, precursor, is geography. You're based in Abu Dhabi. Your companies are here. Your offices are here. your studio is here. Do you see during the course of the first iteration of what you're doing that perhaps you would open up another geography, say something like a Kingdom of Saudi Arabia, over a course of, obviously this year you're starting, you're building, you've got focus, but where you would set up satellite offices? Do you see that in your future, near future, or do you see that as part of the next initiative which comes through, perhaps the second fund?
Um, Great question. We spend a lot of time thinking, once our companies go through the regulatory journey and market launch here, how do they expand to other geographies? And remember, we're focused on regulated businesses, right? And so, yes, we will get together with the partners, and we're like, hey, when these companies get to a point where they need to go to, whether it's Saudi or Egypt or Turkey, wherever it may be, over the course of the next 12, 18 plus months, how can we as an organization more effectively support them? Does that mean we have permanent staff, partner organizations, a full on office there? Honestly, I don't know. I think the answer is definitely yes. We'll need to shape what that looks like. And the focus for the organization now is, frankly, get our companies launched, get revenue through the door, build very, smart, durable teams that we can back for the foreseeable future. And yeah, should those companies and should the board of those companies decide that they need to do market entry, we as an organization are provisioned financially to go and open up those markets for them, whether it ends up being an office or we get on planes every day. It's to be determined, right? I don't think there's a set formula for this.
I think, Gary, thanks. And my last question for you is very much zooming out of the venture studio model for now and look at the venture landscape of capital and investment. You obviously have a lot of conviction on the heavy operator involvement in the company in its infancy, right? You want to let go and work yourself out of a job, as you mentioned earlier. But you're very, very much obviously taking that bet along with everybody else that this is the future of how the construction utilization of venture capital needs to be for the period of time, which is similar to how other venture capital is being deployed. My question is, with that in mind, typical venture capital is not heavily operated. They have sectors of expertise, but they're not trying to cover everything on a business from infancy. They give it some tools, legal, etc., network, and they try and step away. They just keep recapitalizing. Do you think traditional VCs in their current stage or next stage are trying to will evolve into the venture studio model by default? Do you see them trying to perhaps hire operators midstream to come in and help them with companies in some way to justify the next capital expenses? Do you see a lot of people who are in the space evolving to the venture studio model or trying to cannibalize in some way that makes it work for them operationally? Or do you just see them staying in their lane and just more venture studios coming to this region? Is what I'm trying to ask. Do you see existing
Uh,
players evolving, or do you see just more new venture studios coming out of existing players dedicated?
what I can tell you is that there's a lot of, I think, turf war battles um,
It's such a
around.
small
Oh,
market.
is
It's so
I
small.
mean, but not in our market, just in general. You'll see, oh, like studios are doing this and this, and VC firms are doing that, this and this, and accelerators are the way to go, and incubators are this way, but the outliers can only be found by like this size fund. And if you kind of really zoom out, statistically, it's all pretty freaking similar. It is exceptionally difficult to build a company. It is exceptionally rare to build a very, very valuable company. And it is very statistically difficult to do that in a time that you're allotted by the capital markets. And so I don't see as the models converging. I see them always being in some sort of a state of flux. And that various teams will take a different approach to tackling the problem with the thesis they believe they can execute on. In terms of funds, traditional funds moving into the space, I think it's a matter of size, right? If you talk to a $200 million VC fund, they might have a great set of advisors and a pretty good recruitment team on board, and they might have some portfolio value add people. They'll do some sales support. Look, if you go to a multi-billion-dollar fund in the US, when you have, Andreessens and Sequoias of the world competing for an allocation in your, hockey stick company and everything is happening, those guys have exceptional value add departments. They're not venture building, quote unquote, but they have corporate development people to help you with the sale. They have technologists on staff to work with your engineering teams to build up your kind of prowess in that department. They'll have basically support services for almost every department of the business. What's crucially different is that those are support services that they don't actually perform the labor. I didn't coin this term, but venture studios consider themselves what's called an institutional co-founder. We as Further, we take common stock. We're not pref over our founders. We put in the capital, into the money, into the company, and then we are employees of that organization doing the actual work day to day. And so that's very different from having a services company, that is running to the side of a VC that provides support services, whether they're agency, recruitment, technology, whatever that may be, to their companies. And so, those guys are tough to compete with. I think if you are lucky enough, if you're fortunate enough to secure capital from a tier one firm, you should definitely lean into all the resources that they have available to you. I think that funds that are kind of sub 200 million, it gets a little bit difficult, kind of given how much money you have to work with the fees that you have, to be competitive to either the super big boys or the studios in terms of services. Now, that doesn't mean that you aren't better at finding deals or securing allocation, because the GPs might be super talented people, or you have a couple of people that are domain experts in your fund that are sought after. Again, I don't there's a lot of kind of hype saying like, oh, like a studio will outperform a fund. Not really. I think we're all funds, and as financial products, the top decile managers, will all kind of shake out if you're really good in the, in the similar ranges. And so if you really kind of are intellectually honest with ourselves, we're all just taking we're all just taking a dollar, and we're choosing how to deploy that, on across services and staffing in various ways. And you can do it in a pretty simple way by just wiring money, or you can get increasingly complex in terms of what other services or labor are you able to provide. And in some specific cases, being able to build with a certain level of conviction is more advantageous, but not all. I think that consumer services, software is a little harder, to do as a studio, right? Versus regulated, at least in our part of the world.
Gary, it's been a great session. On behalf of Ronit, who unfortunately couldn't be here today, and my partner
Because
CFTE,
he's on vacation,
he is
just
on
just so that we're
vacation.
all clear in for the audience.
We're not going to let him forget, poor guy. Thank you so much for your time. Congratulations on everything that you've built so far with your partners and your team, and wish you all the best. And on your journey with your founders that you're hoping to take to, well, the next steps of where they want to go and where they want to be in the space. So we look forward to hearing from you sometime again, and all the updates that you have, and see you around in the ecosystem. I'm sure a lot of people will reach out to you post this podcast. So thank you, and thanks to everyone on this.
Sounds great.
Thank
Thank
you.
you. Bye, everyone.